2nd March 2023, Thursday, MAO with Kel once again. A global recession is going to happen really soon. Well, I can tell you that August 2023, we will get to see that. And the numbers, the statistics, the data, the charts, the pattern, and the experts are all aiming at that. The only people that probably are not saying this are the Federal Reserves, some of the Fed officials, and of course some politicians, definitely for sure. But guys, this is not going to be a joking matter because we have seen this before and it's going to happen again. So watch this video. It's a must watch, must share, and let everybody know about it. Now once again, disclaimer apply as usual. Make sure that you do a risk assessment, and thank you AIMS for the kind sponsorship. Now first of all, let me show you my Hang Seng trade today. Now today Hang Seng have been pretty lackluster, not really moving much. But fortunately, we still make some money off this today. We have a very clear, this TSCB clear pathway. So we went long slightly around this area and make some profit. We do expect the Hang Seng to go higher a little bit more. Let me take away this one, okay? I believe that Hang Seng later on, right, there is a possibility. I'm doing it live right now, by the way, yeah, okay? Right, it is possible that the Hang Seng later on can go all the way up to here, which is at 20,578 level, okay? So I believe the Hang Seng in the afternoon session can test this level. So traders, watch out for this. This is very possible, yeah? And of course, if that happens, I mean, there's another round of profit for all of us, okay? All right. Now let's recap what happened last night. Well, the Dow Jones recovered from the low end back to close positive. Nasdaq down by 103 points and S&P down by 18. Now, one thing to note, S&P yesterday went down to 3940, the level that I mentioned, very important. 3940 for the S&P 500 is a very, very critical level. I will explain this in details later. But yesterday, the main thing that brought the market up was Caterpillar. Now, Caterpillar is here. It's up by 3.81%. And on its own itself, right, it's one of the the Dow Jones component stock. So yesterday Caterpillar did pretty well, okay, and that basically pushed up the market because we can see Microsoft was down actually. Microsoft was down, Apple was down, Amazon was down. So all these companies were down. Nvidia was also down on profit taking. So if all these big boys are down, right, something must compensate it, and that was Caterpillar. Okay, now for Tesla, we all know that Tesla has an investor day, and based on what I have heard from Elon Musk, seemingly nothing special. In fact, the share price is now slightly trading lower after it. So let's see what will happen later tonight. And of course, the thing is this, we can see from here. Let me just clean the screen up. All right, the S&P 500 and Nasdaq closed lower to start the March bun, which is not a very good sign. And the main thing is, guys, I told you the 10-year yield will go above 4%, and it really, really happened. So guys, once again, when the market was at 3.1, 3.2%, and everyone was saying that it will go down lower, I said, no way, it's going to go back up to 4%. And in fact, my target is still 5%, and it seemingly is happening right now. So once again, this has proven to many people that you really need to watch my MAO and of course find out more in details, all right? So the thing is this, we can see the stock price coming off and bond yield continue to climb, yeah? And the thing is, was 4%. In fact, the 1 year went up to 5% already. And I've been telling you this is very close to the market. It will go to 6%. Okay, I'm very, very confident that we will see 6% for the 1 year yield and about 5.4, 5.5% for the 10 year. If things go crazy, who knows? We can even see the 6% coming up. That means the 1 year yield may go past 6% instead. Now, of course, Federal Reserve President Neel Kashkari was very open. He's very open with his view today. I'll tell you more about him, and he is looking at a much higher rate. And of course, basically now with a much higher expectation, now the market's getting jittery right now. So technology companies are won't be able to enjoy this. So this is Neel Kashkari, and he says that he's very open-minded about the interest rate. Very important is that the signal in the dot plot, and of course the dot plot shows that it's 5.25 to 5.5%. So there's no way there will be any rate cut this year. No way at all, guys. No way, unless something calamity happen or pandemic happen. If not, I'm so sorry. There's no way there will be a rate cut. And of course, you can see from there, Nick came in and reiterated a certain very important point Nick is the mouthpiece of this Federal Reserve, says that the application for mortgages to purchase home tumble again. Now, of course, this looks good, right? But you must understand, because the mortgage rate has went up to 6.7%, that is where the pressure is counting right now. So, of course, you say, if that's the case as well, that means the inflation is going to come down. Well, the problem is not coming down. So there is a lot of big question mark going on, and seemingly the numbers just don't add. And of course, yesterday, the PMI data, oh gosh, it's actually higher. Take a look. The PMI data is actually higher than the last months, and the last few months have been down all the way. For this last one, it went up. So again, that shows that the buying interest is still there, the economy is still very strong, and that is not what Federal Reserve is looking at. So the numbers are not able to produce what the Fed wants, and this is not a good sign at all. I mean, they have a lot of room to actually hike interest rate. So that's why Neel Kashkari came in, and he's very concerned right now because he thinks that the inflation is still way high. He believes that we need to have a higher rate so that we can actually bring it down. And the current wage growth now is way too high to be consistent with the 2% inflation. That means that the wages are still mounting up, and usually when wage goes up as well, inflation will be there. So who is Neel Kashkari? He's an American banker, economist, politician, and the president of the Federal Reserve, one of the states itself, Minneapolis. All right, so this guy has he's a bit like a baller. He actually is on a hawkish side. So he actually came in and said that the wage growth now is too high, and we need to really try to do something to it. As a matter of fact itself, right, he says that the wages is climbing up rather than leading the inflation. So all this tells you that this is not a good sign, and very important, the service economy is not slowing down, and it's very concerning, because if it doesn't do that, that means that we have the reason to increase interest rate. And of course, we all know that by hitting interest rate too much, too fast, what will happen? It will really break the economy. But if there's no other way out, there's no choice. So because of that, right, he actually repeated himself and said that, okay, we caught on the dot plot, and basically they are pretty confident that there will be a rate going up to 5.4%. And of course, at the moment now, the jobs are so strong right now, it's pretty clear in the next meeting, most likely more of his colleagues will be joining him to increase or seek to increase interest rate at more for this year. Okay, all right. And the BIS actually came in to urge the central bank to get the job done. Now, who is the BIS? Now, the BIS is the Bank for International Settlements, and they are asking the central bank, they need to get their job done so that the inflation can be controlled. Okay, if not itself, right, there could be a possibility of a 1970s again, and that's why a lot of central banks who are now, because of the recently there's a deflation, and because of this disinflation, disinflation. So the central banks are making a victory lap, but we all know that this is not the thing. It's too early. And now the thing is that the BIS saying that you really need to do something else. If not, things can get very, very nasty, and that's something that we don't want. So if that's the case itself, to me, we all know that, right? At the moment now, the one that is technically leading the victory lap is actually US, because they think that things is okay. But you look carefully now, Canada, New Zealand, UK, all of them is at about 4% rate area, right? So if let's say there's going to be any increment in the inflation figures or crude oil prices shoot up, right, this number will have to go higher, okay? So this is very clear cut that we are not the end of the rate high environment. There will be more coming up pretty soon. And that's why you can see on the chart right now, the 10-year yield is so strong right now. It's trading above the key 3.9 Fibonacci. So that means that it's going to go up further, and it's very possible to see 4.4% very, very soon, in about probably by maybe August, or earlier. All right, we will see this happening. And of course, if that happened, guys, we all remember this when this was going up here. That was in the October period, right? Remember? Yes, the stock market tanked during that period of time, and that's why you can see Mike Wilson, Michael Harnett, all these guys are pretty bearish right now, because they believe that the October low could be taken out in about a few weeks to a few months time. All right. So because of the yields is going up, definitely the buyers are coming in, not to buy stock market, but it's to buy into the ETFs, okay, for the bond market. So now apparently more than nearly 2.5 billion has flowed in, okay, to buy this ETF, okay. This is really incredible. And why? Because this is like a confirmed thing. It's 4% to 5%. This is a good winning trade, because the stock market now is doing about whipsaw. We all know that the stock market is still at a very high level. So it's better to put this money into the right place first to make some money out of it, because you know that these guys, they pay like 1 to 2%. So even they put in some banks, they pay 5%. It's a show-win deal. All right. So of course, if that's happening right now, that is whereby I believe the equity market will be tripped. Because why? Imagine if everybody go to the bond market, right? Equity market will have to come down. So at the moment now, you can see that the 3 months are 4.85%. The 12 month here itself, we have is 5%. And of course, here we go. All this information tell us that it's better to invest in the bond market to get the yield rather than put yourself in a position to be whipsawed by the boys in the Wall Street, right? So you can see that the liquidity now is really at the highest, and the last time we saw this was back in during the 2019 period. That was before that was during the pandemic time. So once again, when funds heavily go into bond market, that means that equity market usually will fall. Okay, so we can see right now that the US, give me a mortgage bank rate now. Give me a moment. Okay, you can see right now the 30-year mortgage rate has rises to the highest since mid-November, and that's 6.7%. This is not good, because that means that people have to pay more money for whatever they have paid for their house. And of course, now the worst thing at the same time is the home prices is plunging now at the same time. So that's a double whammy, because when your home is still in the rising prices, it's still not so bad. But if your home price is going down and your mortgage rate is going up, you're going to have double whammy. And of course, very soon that could be the delinquency. All right, it could cause that, and that is something that you don't want to happen. So what is going to kill the market now is crude oil, and I've been telling you this to buy some crude oil, and you can see very clear crude oil is now trading nearly to the same level of January and February period. And if that's going to happen, this is not a good sign, because you can see right now the trend shows that the market has break above, and it's very soon that the $83, which is the moving average, that's moving average 150, all right, 150 moving average, all right, it's going to touch $83, and of course at $89, that is where the moving average 200. Okay, so my view is still is 96. I strongly believe that crude oil will be able to hit $96 by probably, if I get it correct, by August itself. Okay, by August 2023, we should be able to see crude oil trading $96. And of course, if that all happened at the same time, I cannot imagine what will happen to the inflation of the entire world itself. And of course, at the moment now, at this current price, the natural gas futures have hit 1 month high, and people are not happy right now, because this is bad, especially for places coal. You can see that now. And of course, Goldman Sachs reiterated that they believe that there will be an oil price spike in 2024. Now, of course, you say that it's still too early. God, got it wrong, guys. Remember, they were looking by 100 a barrel by the 4th quarter this year already. And I can tell you this, guys, if you usually, when you see this, you have to mark down at least by 1 quarter to 2 quarter. So which means by the 2nd quarter or the 3rd quarter latest, we will see the $100 a barrel. And of course, if that all happened, you cannot imagine how crazy things will be. And right now, right, example for this, the gas bills now in this particular place, let me get it in my, okay, in South California, apparently some people are very unhappy because now the SoCal gas is asking for a rate increase in the prices of the gas. And of course, this is ridiculous. Apparently, one from Woodland Hills says that her bill is at $1,025 US. This is really ridiculous. And they actually practice saving. That means that they actually stop heating their home after 7 p.m. and they wear 3 layers of clothing, and their bill is $1,000 US. That is crazy, and it's phenomenal. And of course, if that's going to continue, and if crude oil price also go up at the same time while the economy is coming down, I cannot imagine how bad would that be. Then of course, you may keep on saying, KL, you keep on saying recession, show me some numbers. Guys, I'm showing numbers and numbers and numbers. This is one of the better one. The mortgage purchases per application index has came all the way down to 1995 low, and this is worse. This is the time whereby we are supposed to have the best of the economy, but the numbers are just not showing. And this one, the next one's coming out, it's going to be a blockbuster, mind-bending, guys. Look. Now, this is the gross fixed capital formation in United States of America. And you look at it, every time when the index go below the negative figure, which is go negative, recession is instant, okay? Now, there's one that's flipped a little bit in 2006, whereby it went negative for a while, then after it rebounded, but you notice it never crossed above positive, and that whereby the next moment we have recession. So even during the pandemic time, we saw it. So now, guys, we are really way below the negative figure, but the market is still not taking it as a recession. So to me, it's just basically kicking the can down the alley. We all know that we are having recession right now, but of course the numbers are not official yet, so we just have to wait. All right, but to me, this is a very clear chart. You can't run away. Things is going to get very messy. All right, so Mike Wilson, as always, so bearish. So let's just see what he has to say. And I think this 2 minute is something you need to watch. Okay, let's go.
I haven't asked for a pinpoint number, but I'm sure you can give me a range. What kind of range are you thinking about?
Well, the range isn't so important to us, John. It's more about, okay, what happens with earnings? Okay, so if earnings come down, and we've talked about this before, if earnings come down in a way that we think is appropriate with the path that we see, and we don't get a reset on price, then we'll just say it's over, okay? So that could be here. That could be, down 5%. It could be down 20%. Our work suggests it's going to be down closer to 20% from here. So clear low 3,000s. We don't have a crystal ball, obviously, but what we can confidently say is that the equity risk premium and the multiples that are being reflected do not reflect the earnings risk that we see. And we think the reason why that's happening is twofold. Number one, the economy is better, and people were not thinking that 3 months ago. I would say the biggest shift in that regard is, 3 months ago, most institutional clients thought that a recession was very likely. Now they're thinking it's not so likely anymore. So that's a big, sea change. And then, of course, this liquidity picture that we've been writing about and talking about, where global money supply growth has been more than offsetting what the Fed has been trying to do with tightening financial conditions, and that has created sort of an ebullient environment for asset prices. That's not sustainable in our view, but the timing of that's been a little tricky.
Mike, I'm sure you get a ton of questions.
All right, I'm pretty sure that he will cover more, but my main thing is this is very clear information that he is looking at the S&P 500 to fall by 20%. And of course, you can see in stages of this video, interviewed the last 3 weeks to 4 weeks. One was that, okay, there's a possibility, then a stronger possibility, and this time around, straight in the face, he's saying that. All right, let me just continue this video to watch it finish, yeah?
The October low. Based on everything you've said, obviously we don't have a crystal ball. A lot of people would lean on market history though. How rare would it be if October was the low?
Well, okay, let's assume a few things. Let's assume that our earnings forecast is more right than wrong, meaning that the forward estimates have not yet troughed. It would be somewhat unprecedented from a timing standpoint to, let's say that earnings trough sometime this summer or in the fall when we think. It would be unprecedented for the market to have bottomed that far in advance, okay? But of course, we could be wrong about our earnings forecast, right? We don't, that's another thing. it's not infallible. But the odds are with us. The odds are, because our model is very much in gear. We have to go with the probabilities, and that's why we've been making the call we've been making, is that we just don't think the bear market is finished because the earnings recession is far from finished.
All right, very clear, very powerful statement, and indeed, he is very clear with his view, and I believe in what he says. And of course, the statistics that I've been collecting were the same thing. So to me itself, this is going to happen. 20%, not too sure, but probably hitting October low is a very high possible. Yeah.
Using my mechanical trading rules.
All right, so we're going to look at it and see what we have for you guys. More details coming up. Let's go. Now, this is the S&P 500, and yesterday I repeated and said that the 3940 is a very critical level because that is the MA 200. And last night, the S&P really went down to 3940 and really rebounded from there. Oh my goodness. It's so orchestrated. It's so manipulated. And I can tell you this, guys, this is not going to be the end. This is just the beginning. Let's watch this, guys. Look at the S&P 500 on a day chart expanded out. First of all, the market hits the 150-day average first on a day chart, went up, touched a trend line, and rejected beautifully here. Okay, then it came back down, and it went down to touch the 200-day moving average beautifully, no more, no less, 3940. Now, of course, you may say, hey, where will the algorithm? You said it will be algorithm. Yeah, correct, but you must have a certain magnitude, not that just touch and then the market will sell, right? There must be like it stays there long enough, or it basically go down to 39, 35, something like that. Then you can see the algorithm kicking in, and that is where I suspect we'll see one more time, two more time very soon within these few days. Yeah, and of course I did something more for you. I actually showed, take out the chart for you right now. You can see that this is the 5-minute chart. The market purposely sold down exactly, reaches 3940, and then instantly rebound with a BNB, guys. For my TWB student, you see it's a BNB at the low end, and that is where it warranted a recovery all the way. Then it tried to come down again, but this time around didn't even go near to it, and then rebounded. Okay, so my view is simple. For people who are bullish right now, you can buy anytime here and put a stop loss at 3940. Okay, so that you have your risk only from here to this point, and if the market goes up, then it'll be beneficial for you. That's only for people who are bullish. Now, for people who are bearish, then my view is very simple. Just wait on for a while, let the market come down to 3940, and put a sell stop below it, and put a stop loss maybe at 3950, 3960 level, and that's it. If the market really is weak, it will go down all the way. Now, according to what Mike Wilson say, minimally, he's looking at least 3900, right? That was what a few interviews ago. So to me, it's a very good, it's a good date here. It's like the downside itself, right, can be 3940, 3900. And of course, if this goes lower, we can see really going down to the target he said was 3000. So imagine this, guys. Imagine if you sell at 3940 and you aim at 3000. That's 940 points on S&P point. I can tell you, you should be very happy. We're laughing to the bank. All right. So this is the day chart overall. I don't like it. You can see this is A and this is B, because you can see the RSI here. These are common points, and the market shows that it's actually coming down. So 3900 will be the Mike Wilson level. My personal level is 3781 for the first support if the market breaks 3900. But if you talk about the official low back then in this October, I think we can look at 3520. I think that'll be a good level to buy back some of the shorts. Okay, so 3900 is a first, 3940 is a first major support through the MAs. Then 3900, you can book some profit if you want to, but if the market breaks below 3900, the first level it goes 3781, and of course the next number will be 3520. All right, so this is all my numbers. I wish you take note of all these things so that you can make some money out of this. This is our very important numbers. I believe that you guys is going to benefit from this run. Okay, all right, so that will be all for now. We're going to look into Binance. Binance is an issue apparently. Now, apparently Binance, in the latest backroom maneuver, Binance has just transferred $1.8 billion in stablecoin collateral to hedge fund. Okay, and this is very similar to what happened in FTX. So guys, I wish nothing happened to Binance. If Binance get into trouble, a lot of really bad thing will happen. And look at it at BTC now. At the moment now, it's still doing cold. To me, it's very simple. If the BTC can stay above 23,000, well, we can still see going up to maybe back to 26,000 again. Okay, that's my first upside view. On the downside view, if the market breaks 22,000, guys, this is going to ring some alarm bell, because it will bring it back down to about 19,000 again. Okay, all right, so of course, if Binance get into trouble, this is going to fall. So whether is it by coincidence or not, but you can see the volume is going down, this is not a good sign, guys. This is really not a good sign at all. All right, I'll see you on the technical side. This is Kel signing off. Bye bye.